The United States government holds 8,000 tons of gold in reserve. That number has remained unchanged since 1971. The price has not. When an empire's gold appreciates faster than its currency, the empire is no longer pricing gold. Gold is pricing the empire. Between 1929 and 1934, gold doubled against the dollar. The government responded by making private ownership illegal. Between 1971 and 1980, gold rose 1,500%. The government responded by abandoning convertibility entirely. Gold is not rising, the system measuring it is collapsing, and every empire that reached this inflection point made the same three decisions in the same order. The United States is currently on decision 2. Right now, financial media is focused on gold's price, $2,000, $3,000, the psychological barrier of $5,000. They are watching the wrong hand. The left hand is not the price. It is the ratio, gold to debt, gold to money supply. Gold to the Treasury's ability to defend the currency without destabilizing the bond market. The price is theater, the ratio is structure. When gold doubles against a reserve currency, it is not a bull market. It is a margin call on the government itself, and every government in history has responded the same way. They redefine the terms. In 211 AD, Roman Emperor Caracalla doubled the silver content required to mint a denarius. The coin remained legal tender, the metal did not. The empire was not debasing currency to fund wars, it was debasing currency because the gold-to-silver ratio had collapsed. The aureus, Rome's gold coin, had become too expensive to maintain parity. The government chose inflation over convertibility. 15 years later, the denarius was 90% copper. 50 years later, Rome stopped minting gold entirely. 100 years later, the empire fragmented. This was not corruption, it was mathematics. Spain followed the same script. Between 1500 and 1650, Spanish galleons brought more than 200,000 tons of silver from the Americas. The crown used it to fund wars, maintain empire, and service debt. But the gold-to-silver ratio inside Spain inverted. As silver flooded in, gold became the harder money. Merchants hoarded it. The crown debased silver coins to chase liquidity. By 1650, Spain was minting copper coins stamped with silver denominations. The currency survived, the empire did not. The Ming Dynasty banned private gold ownership in 1436. Not because gold was scarce, because it had become more trusted than the paper currency issued by the state. When a government bans gold ownership, it is admitting the public no longer believes in the system. The ban itself is the proof. Britain went off the gold standard in 1931, not by choice. The Bank of England could not defend the pound and hold gold convertibility simultaneously. It chose the currency. Within 6 years, Britain lost reserve currency status. Within 12 years, it began liquidating the empire. These were not policy failures, they were structural inevitabilities, and the sequence is always the same. First, gold appreciates faster than the currency, then the government restricts convertibility, then the government redefines value, then the empire contracts. The United States completed Step 1 in 1971. It is currently halfway through Step 2. In 1971, President Nixon closed the gold window. Foreign governments could no longer exchange dollars for gold at the fixed rate of $35 per ounce. This was not a temporary measure. It was a permanent severing of the dollar from measurable value, but the gold remained, 8,000 tons, stored at Fort Knox, West Point, and the New York Federal Reserve. The government did not sell it, it simply stopped honoring it. That gold is now worth $650 billion at current prices. The national debt is $36 trillion. If gold were still convertible, the reserves would cover 1.8% of obligations. That ratio is not an accident. It is the mathematical exhaust of a reserve currency in late-stage decline. There is a mechanism most analysts do not discuss. It is called the Exchange Stabilization Fund. Created in 1934, it allows the Treasury to intervene in currency and gold markets without congressional approval. The fund is authorized to buy and sell gold, foreign currency, and financial instruments to stabilize the dollar. It operates in secrecy. Its transactions are not published in real time. Its balance sheet is exempt from standard disclosure. When gold rises too quickly, the ESF can lease gold into the market through intermediary banks. The gold never leaves the vault. The paper claim does. This suppresses the visible price without reducing the official reserve. It is legal, it is unauditable. And it has been used in every major gold price suppression event since 1990. The system is not free market, it is managed, and the management only works as long as the claims remain theoretical. When claims convert to delivery, the mechanism breaks. The Federal Reserve's balance sheet is $7.4 trillion. The monetary base M0 is $5.8 trillion. The broader money supply M2 is $21 trillion. The gold reserve is worth $650 billion. If the Treasury were forced to back even 10% of M2 with gold, the implied price per ounce would be $32,000. That is not speculation, that is division. The current price is $2,700. The gap between current price and backing requirement is a factor of 12. Every time that gap has exceeded a factor of 10 in a reserve currency system, the system has either collapsed convertibility or collapsed the currency. Rome collapsed convertibility in 270 AD. Spain in 1627, Britain in 1931, the United States in 1971. Each time the next step was revaluation or restriction, the United States has already collapsed convertibility. The only remaining option is revaluation, and revaluation by definition means the current price is wrong by an order of magnitude. There is a common belief that gold is a hedge, a safe asset. Something you hold when uncertainty rises. That belief is correct in normal markets. It is wrong in terminal currency events. In terminal events, gold does not hedge, it exposes. When gold doubles against a reserve currency, it signals that the market no longer trusts the issuer to preserve value. That distrust spreads, bonds fall. Not because of inflation, but because the collateral, the currency itself, is losing coherence. Equities fall. Not because of earnings, but because they are priced in a unit the market is actively abandoning. Real estate falls. Not because of supply, but because the denominator, the dollar, is becoming unstable. The traditional safe havens, treasuries, dollar-denominated cash, even FDIC-insured deposits are all expressions of the same system. They do not protect you from dollar failure. They are dollar failure. Gold's rise is not a signal to buy gold. It is a signal that the alternatives have already begun to collapse, and the government knows this. In 1933, Executive Order 6102 made private gold ownership illegal. Citizens were required to surrender gold to the Federal Reserve at $20.67 per ounce. 4 months later, the government revalued gold to $35 per ounce. The profit from that revaluation went to the Treasury. The loss went to the citizens who were forced to sell. This was not theft, it was legal. The Gold Reserve Act of 1934 gave the president unilateral authority to revalue gold, restrict ownership, and penalize noncompliance with up to 10 years imprisonment. That law was never repealed. It was amended in 1974 to allow private ownership again, but the authority to restrict remains intact under the Trading with the Enemy Act and the International Emergency Economic Powers Act. If the Treasury determines that gold hoarding threatens the stability of the dollar, restriction is not only legal, it is precedented. There are 3 phases to reserve currency collapse. Phase 1 is denial. The currency is still accepted, trade continues. The government insists the system is sound. This phase lasts years, sometimes decades. The United States entered Phase 1 in 1971. Phase 2 is recognition. The market begins pricing the currency against hard assets. Gold rises, commodities rise. Foreign central banks diversify reserves. The government responds with intervention, but the intervention is visible. The United States entered Phase 2 in 2020. Phase 3 is repricing. The government can no longer defend both the currency and the bond market. It must choose. If it chooses the currency, interest rates explode and the debt becomes unserviceable. If it chooses the debt, the currency collapses and imports become unaffordable. There is no historical case where a reserve currency survived Phase 3 intact. Rome chose inflation. Spain chose contraction. Britain chose managed decline. The United States has not yet chosen, but the math is tightening. The deficit is $2 trillion per year. Interest on the debt is $1.2 trillion. The Fed cannot raise rates without collapsing the Treasury market. It cannot lower rates without collapsing the currency. Gold is not waiting for the decision. Gold is pricing the inevitability. Empires do not end with invasions, they end with math. When gold doubles against a reserve currency, it is not predicting collapse, it is measuring it. Rome, Spain, Ming, China, Britain. Every empire that reached this threshold made the same sequence of moves: restrict convertibility, debase the currency, redefine value, contract territory. The United States has already restricted convertibility, it is already debasing through inflation. The only question is timing, and timing is not about prediction. It is about watching the mechanisms that have already been activated. The Treasury still holds 8,000 tons of gold, it has never sold, it has never explained why. It has never reconciled the ratio between reserves and obligations. That silence is not ignorance, it is strategy. If you are watching the price of gold, you are watching the wrong variable. Watch the ratio, watch the interventions, watch the legal structures that are already in place. The system does not need to announce its intention, it already has. And if history is structure, not story, the United States is not exceptional, it is next.